All right. Welcome to another episode of Momentum Mondays. My name is Garrett. This is Matt. It is Monday, April 14th, 2025, and had some interesting developments in the market last week. What does it all mean? What potentially could it mean? Have we found a bottom? Where could we go from here?
Very interesting
Lots
discussion.
of stuff to talk about. I'll throw it to you for this says required disclosures, but I think we call it the fine print. So I'll throw it over to you for the fine print.
As always, before we get too deep into the start of the show, a quick reminder, nothing we share on this podcast should be considered personal financial advice. Always consult with your advisor before making any investment decisions. Momentum Wealth Management is a registered investment advisor, so feel free to go to momentumwealth.us for more information.
Wonderful.
It changes every week.
We like to keep people on their feet.
Yeah.
In case some people
it's
that
my
might
favorite part of the
I was about to say it might be some people's favorite part of the show. We'll keep them on their feet. Anyway, last week of April 7th in the markets was an interesting week. We had a pretty big day. We were talking about it a little bit before we push play on this thing, or record rather. We had a big day in the market. What was that? Wednesday, Thursday, something like that? Wednesday. It was Wednesday. Yeah.
When you get these huge market moves, and I remember this both during the COVID downturn and subsequent recovery, and then the interest rate mania that took place in 2022, first part of 2023, it's kind of hard to keep tabs on what day these movements happen.
It was Wednesday. I remember it was Wednesday.
Yes, but I just pulled it up, and I can validate and verify that it wasn't Wednesday.
So we got the S&P up 5.67%, the NASDAQ up 7.5%, the Dow Jones up 4.88%, and the Russell 2000 lagging behind 1.75%. For last week, remember, we've got gold up 6.5%, silver up 7.7%. 10-year bond, this is the price, was actually down 3.16%, which means the yield was up. We can talk about that in a minute. Bitcoin down 4.78%. It's about the same as it was last week. If we kind of zoom out, let's check our year-to-date. S&P still down 8.62, NASDAQ down 10.99, Dow Jones down 5.18, and the Russell 2000 down 16.38. Very near bear market for the Russell 2000. NASDAQ kind of pulled out of that a little bit. Gold up 23.05, now the winner for the year. Silver really took it on the chin a couple weeks ago. They're only up 10.8. 10-year bond price up 2.09. And then Bitcoin down 9.7% on the year.
We have some of that flipping today.
Yeah, with the 10-year, yeah. We're talking now, the market's open. We do have some of that flipping. The 10-year is falling. But, this is a really weird time. We talked last week about we had some indicators that urged us to sort of raise cash because of the uncertainty and some things that were happening in the price movement and the price action, which is what we look at really when we're managing the funds that we manage for our clients. And so, some people, you look at a week like last week and you kind of scratch your head and say, well, is the worst over? Is the bottom in? Is this like, what should we do here? How should we position? Because we kind of pivoted to be sort of more defensive in our portfolios.
Yeah. Being tactical money managers, which is what we are, a portion of the portfolio is always tactical. A portion is always fully invested. And we do that based on data. And if you'd like to get kind of specifics of what's occurring and how, because today's a very interesting day where all of our portfolios are performing as if almost we were 100% invested. So we're getting some pretty good upside today, and we can always give you more specifics at momentumwealth.us, so we won't get into that. But, the important, when you have a tactical part of your portfolio, it's very, very important to pay attention to the data and not the headlines. And more times than not, you end up in a pretty darn good situation to redeploy capital as the market kind of hits the reset. And that's the really big question is, have we hit the reset?
Yeah.
And I don't think we really, even during COVID, when we talk about what was referred to as the super V recovery or the V recovery, it was really a few weeks into that before you could look back and say, okay, this is what happened. I can see what's happening. My gut is telling me that the uncertainty is driving a deleveraging in the market. And so I think that as weeks go
Meaning
on,
what?
meaning,
What exactly does that mean?
So I have a note here from Bank of America, one of their top analysts. It goes on to say that a massive number, their word, not mine, large, huge, massive number of hedge fund short sellers were net short to a degree not seen since COVID. In fact, there is some data that's coming out saying it's twice the amount of short.
And
that
so we
occurred.
talked about short a little while ago, but
Short is when you're betting against the market. So you're taking out.
you want to make money when stocks fall.
Correct. You're using leverage. Margin always uses leverage. You're using leverage to sell at the current price in expectation that you can buy it back lower.
Right.
And leading to the tariff announcement day or the strategy day with Liberation Day. Is what they
I
call
was
it.
going to say Freedom Day, but Liberation Day.
Leading to that, it was significant, and this is something that really, unless you're on the market making side or an institutional trader, you don't really see this in real time. You get this data after the fact, so you can kind of go back in time and see, wow, that was a significant amount of short. Well, that works until it doesn't. We saw Wednesday was a huge up day. That is. I'm pretty confident that was short covering. We're probably going to see a few more days like that. That deleveraging is where you're covering your short position. You're paying back your margin loan. You're deleveraging in the trades, and that is healthy for that to occur in the market. But is that the only thing that's happening? Because there's been some crazy movements in the bond markets.
Yep.
That could also be a signal of some type of deleveraging that's happening. If you're not aware, the West operates on leverage. The West is a debt-based system, which brings us to the historic booms and busts that have occurred ever since the creation of the Federal Reserve System in 1913. And the Federal Reserve System was basically put in place to try to smooth out the booms and the busts that occur through the debt cycles. So this is commonplace to see in the market. It's going to be very interesting as the next few weeks, I think around 6 to 8 weeks, play out, to kind of look back and see. And now this provides people who are tactical a beautiful opportunity. It provides people that may, by default, they may be being a tactical investor and they don't know it because they're on the sidelines, or maybe they haven't looked at their 401k in a while. It's a great opportunity to rebalance. It's a great opportunity to look at your risk tolerance. We've been getting several calls, as we typically do when there's market downside turbulence occurring, market downside excitement occurring. For people that are like, okay, I've been on the sidelines or I've got this extra cash. What do I do with it? It is a beautiful opportunity to have those discussions. You have to also keep in mind that no one knows when the volatility ends and we're going to have a 6 to 9 month straight up. Nobody knows that. If they're telling you that, they're lying. They'll never put it in writing. They definitely won't say it on a recorded phone call. But
well, it's interesting the fact that you say that with the calls that we have been getting. We've been getting quite a bit of calls, and so it's not always like that. We've been doing this long enough to know that over the cycles, it's not always people calling wanting to add money to the market.
That's right. That's true.
So there are certain, at least anecdotal, sort of sentiment indicators that we're seeing that look, that would tend to be more positive of an outlook. But then you have things like what you were saying with the bond market, where we have a yield curve that's inverted. We have people, going longer on the duration. And
that could be fueled by uncertainty, because you definitely
see that when there's economic consternation.
You have, to every price movement that occurs, there's always generally there's two parties involved. Sometimes more, but we won't get complicated here. There's two parties. You have a buyer and a seller. You have somebody.
People are going to be mad that you didn't get complicated.
You have trades that are unfolding that are mutually beneficial, at least from the parties' perspectives. And so you may have people that are wanting to sell out of bonds to take advantage of the dip. You may have people that are saying, listen, I need this guaranteed income. Maybe they're pension funds, maybe they're endowment funds that kind of have more of a statutory obligation to produce a certain amount of income, that are saying, the uncertainty is too much for me, so I'm going to go out on the duration curve. I'm going to lock in a 4.5 or a 5 on a 30-year. That's fine for right now. We'll change it up later, year or two. And so when these are occurring, yes, both parties are trying to make the best decision for what's good for their specific situation. But time and again, what I have seen in the years and years of doing this, and the thousands and thousands of interactions with clients and prospects, is that most of the time when you trade on uncertainty, you're not really going to have a certain path forward for your own financial plans and financial goals. And you can have a lot of worries. You can have inflation worries. You can have unemployment worries. You can have tariff worries. And there is always the risk or the potential, depending on what side of the trade you're on, that those worries don't materialize. A lot of times the news and the expectation is a lot worse than what actually occurs. And when you have this convergence of all of this uncertainty, I always go back to the basics of, if you're a long-term investor and you can white knuckle through the uncertainty, the markets shift from being a voting machine on what's happening in the day-to-day to being a weighing machine on who's going to accumulate wealth in the long run. But, for us and for people that pay attention daily to what's going on, we started off the year with our annual review theme being, market excitement. And that doesn't mean that it's excitement that goes your way,
yeah,
right?
I would still say it's market excitement, yeah.
It could be any type of market excitement. But it's very interesting what's happening with the bond market. Are we through the worst of the gyrations? Some people say yes, some people say no. What say you?
Well, you could say it either way, because again, what we've been talking about for the last few weeks, I can't remember the last time we didn't say it, but when we're looking at technical indicators or indicators of sentiment or anything like that, it's still just a mixed bag. It's not saying we could still go one way or the other, basically. It's not giving us a surefire, confident position to say that it's over. You have moving averages that are trailing the indexes. That would be something that we would consider not a sign you want to see. You want to see indexes either meeting or beating their 200-day or 50-day moving averages. You're not seeing that a whole lot. The breadth is another thing we talk about a lot here. That's really low right now. I'll be interested to see what it is today after it closes. But it has been, at least over the last week, not great. So we see all of these kind of technical aspects of the market giving us cause for concern. The bond market certainly giving us cause for concern. These are things that are happening in the bond market that would tend to historically signal either the market is expecting slower economic growth or maybe a recession or something like that. And so,
but then we have like the jobs report on Friday.
Yeah, but we have this mixed history with the jobs report. It's revisions, the way they count certain jobs. Jobs is they almost have to break that out, and they do, but it doesn't get the headlines. Jobs is just all you see is jobs, plus 500,000. Well, what kind of jobs are they? Are they long-term jobs? Are they short-term jobs? In an economy that is really, blowing and going, you're not going to see a whole lot of short-term part-time work. What you want to see is full-time employment. What you want to see is wage growth. We are seeing the wage growth in a certain respect, but we're also, at least over the last year or so, the job growth has been, government job or short-term jobs or something like that. So we want to see that sort of shift and change. The other thing we talked about before is that, with all this stuff with the tariffs and specifically China's not a huge buyer of treasuries anymore. They kind of rolled back on that. So what does that mean? The Trump administration has said they basically don't want China. They don't want their money. They want them to take the money and go home. So what does that mean? China has historically been a big buyer of equities, U.S. equities, not directly in stocks, but through sovereign wealth funds or indexes or something like that. So what does all that mean? And does it mean that we should be expecting further volatility? I think yes. I think we should expect further volatility. But the thing about volatility is that it doesn't just go down. You can have volatility to the upside as well, and it can go crazy and shift, and you can have high highs and low lows. But at the end of the day, it just starts to sort of shake itself out of this kind of uncertainty.
Yeah.
And I don't think the Trump administration is helping it by any means. I think their communication is abysmal. I think the back and forth of, there's going to be exclusions, there's not going to be exclusions, we're going to revisit in 90 days, no, we're not going to revisit in 90 days. I think that is...
Which is why you shouldn't trade on the news and the uncertainty and the communications that are going on, because, at the end of the day, for instance, just on the U.S.-China the Chinese basically essentially stopping over a period of time. They went from
Well, they haven't stopped. They've pulled back significantly.
So they went in 2013 around 1.3 trillion of U.S. Treasuries. They've been gradually selling off with accelerated sales in recent years, basically halving their Treasury, going into other asset classes, including U.S. farmland. And the Japanese bond market, which is interesting. So you can't, nothing moves as you think it would right at the beginning.
Right. There's no surefire things.
And so that's why you can't trade off of political announcements. You can't trade off of White House announcements. Now, I would say that
you also can't trade off of one day where the market is up.
Or
even
down.
if it's an index, if it's up giant, we had days back in, not to, I hate making the comparison to 2008, but going back to 2008, in October of 2008, you had 2 days during that month that were up. The indexes were up 10 to 15%. And then following that, everybody knows what happened. But that in and of itself is not indicative that we're turning around or that we've found support or that we're out of the woods.
Yeah.
And so that's what we would caution, is that we're probably not out of the woods. I would be shocked if we're out of the woods.
Yeah.
I've been wrong before. I might be wrong here. There's an analyst that wrote a book about the market, and one of the little quotes in the book was, the market will do whatever it has to do to embarrass the largest number of people. And so that tends to be true. I mean, nobody really knows. It's just all speculation at the end of the day.
And then today, as we're talking, news breaks that looking, CNBC, there's around 10 countries that they're saying have made amazing trade deals, and it's now whether or not you're going to hear them one by one or all together. So you have things like that can occur that can catch the shorts. What is the saying Warren Buffett said, that when the tide recedes, you see who was swimming naked, basically.
Yeah.
So that's in reference to naked short selling too. But
the title of the book that I just referenced is something like, when the time comes to buy, you won't want to.
Yeah, and that's why. And if you're hanging on to every word that we say, or that anybody that's putting out information or entertainment, you can't do that. You can't look for an individual speck of clarity or some type of perceived hope. You have to really have a long-term plan. You got to sit down and you got to talk with an advisor to come up with a long-term strategy that works in all market conditions, that works regardless of shifting political sands and the political policies that are being done. I mean, one thing is absolutely for sure: the global order, as it revolves around trade, the post-war order is dissolving. It has been for some time, and you can't cling to the old way of doing things. You have to be very purposeful in your allocation. You have to be very purposeful in your strategy to make sure that you win in the long term. And it's so frustrating because, regardless, people spend way too much time paying attention to the news to try to make decisions about their life. And a saying that I've said for a long time, and I'm sure I've heard it from somewhere, and I just repeated it because it really stuck with me. You have to first worry about your house before you worry about the White House. You have to worry about your family, your business, your balance sheet before you worry about others' balance sheets and what's going on. And when you take that approach first and get back to basics and first principles, you can weather the volatility beautifully. And you don't get returns without paying the price of volatility. You just don't get it. And that's why so many people lose in the long run, is because they get scared off what they're doing. They get scared off their strategy, or they never develop a strategy because, if all you're doing is consuming media that's being put in front of you for a reason and for a purpose, you can't think about yourself first, because you're always worried about everything else that's going on and these million different variables at play. You had a great conversation with a vendor contractor that we've used over the years that was kind of on the sidelines asking for your advice. And, the best advice that you gave him that was relayed to me is, first of all, you got to get off zero. You got to get a simple and easy strategy to start saving some money and start putting it aside, and don't worry about everything else that's going on. And, then over time, as you become more sophisticated, that strategy can evolve and be augmented and become, more subtle and nuanced to everything that's going on in the world. But, you just can't trade off of all this stuff that's going on. You gotta.
It's very difficult.
You can't do it. Can't do it.
Yeah, I mean, that's the hard thing about sort of investor psychology and somebody who's saving and who is, maybe getting close to retirement. This sort of a different kind of mindset is that it's concerning, it's scary, what's going to happen, but ultimately, yeah, we have to focus on long term. And long term, we know that the trajectory of the market is up. Are there some downtimes? Sure.
Mm-hmm.
Are there some significant downtimes? Yeah. Are there some really scary downtimes? Of course. But once we roll past that, we have to look at just going back to the 20s or 30s. I mean, look at the market since then. We've had terrible years. We've had 01, we've had 08, we've had,
And you talk about
2022.
anecdotal examples. I mean, we've been doing this long enough that it's not just words that we're saying. We have lived it and we have seen it.
Mm-hmm.
We've taken clients from, to places they never thought they would be by just being disciplined, having an approach that we stick with. We have a process that we trust. We let the data lead us. And it's not, so we're not just saying, it'd be nice if people focused on the long term. We have done it and we have seen the results.
It's just hard to focus on the long term because you get people who are not really familiar with that way of thinking, and maybe they check their balances too often or whatever, and they get discouraged when they see the number go down, and that makes them just want to go to the sidelines or something.
Yeah, but you don't do that with your house. This is a great example I've used 1,000 times. If you're living in a home, you're in a good school zone, you're in a good area, just like, if you're in the U.S. market, you're in the U.S. stock market, it's the best economy on planet Earth, the most dynamic economy, the smartest people, and, the greatest wealth generation tool that has ever been conceived and implemented is the U.S. economy. It is not perfect, but when you look and compare us to everybody else on planet Earth, the wealth that has been created and will continue to be created is unimaginable. Really, it's hard to grasp. And
it's magnetizing for people who are not here. They want to be here.
They want to be here. They want to be a part of it. And, so when I use a house as an example, you're in a great school zone, you're in a nice city or a nice suburb, that the price of that house is going to go up over time. And if you have a year or two where, somebody comes by and offers you 20% less than what you paid for the house, you're not going to immediately sell your house just because they offered you less. You got to think about your stocks, your assets in the exact same way. Just because the market today is pricing your Apple stock at 20% less doesn't mean you have to sell it. It's just today's market opinion on what those shares are worth. And just as you wouldn't immediately liquidate your house because, somebody came or your neighbor sold it for less than what you would sell yours for, you just don't do that because long term the value of my home is going to go up.
Yeah, I would say the maybe just to play devil's advocate here is if you had a house in an area that was deteriorating, or if you were living in a neighborhood that maybe you were concerned that your home value was going to start falling, and should you take some action to maybe get out while you can and hold the value of the home and move to a different area or something like that.
That's more of a rebalancing.
Yeah, it's true. But it's no scare. It's no. It's still sort of a scary, kind of uncertain environment. And I'm not advocating that, you should do that, but...
but had you consulted with a well-versed broker, an agent, before you bought the home, you would have avoided the mistake of getting into an area that
maybe
would go down.
Potentially.
So that's where working with a good advisor helps you avoid the bad areas. But once you get a good strategy is my whole point. Once you get a good time-tested and proven strategy, then you don't have to worry about all of those
That's
things.
True. The long-term view is the best one. Absolutely. Yeah. Not arguing with that. It's hard for people to do that. And particularly if you're getting closer to retirement, it's actually hard for people starting out to do that as well. And so it's for different reasons. It's super easy to get started now. I mean, even 10 years ago when we started, there was huge barriers to just doing it even on your own or working with somebody.
12 years ago.
12 years ago. Yeah, there you go. But yes, the thing that people have to understand is that there's a mathematical, formula that happens when you reach a certain balance that the market will provide more growth that you can add to it. And a lot of people don't realize that. They want to start doing $100 a week or whatever to their account, or $50 a month, or whatever they can do, and they want to see it go up, and it will go up. But then, when we have a correction or something come in, it will generally go down, and they will kind of be discouraged because it's this sort of back and forth and this pull and tug with the immediate gratification of our culture. I mean, we need immediate gratification. We need the always open drive-through. We need the scroll to refresh. We need all that stuff. And so when we see things,
need those dopamine hits.
Yeah, when we see things going the way we don't want them to go, it often gets discouraging. But we always tell clients between $270,000 and $300,000 is the sweet spot. That's when the account really starts to take on a life of its own, starts to experience that exponential growth above and beyond what you can put into it. And it's hard to get. It's hard to get to. It's an uphill battle, literally, all the way there. But you can't let anything discourage you. When the market pulls back, don't let it stop you. When something comes up, the life always happens. If you have to take a break from it, try to get back as soon as you can to putting in money, saving, because it's going to work out over the long run.
Yeah, I mean, it's like if you have 100,000, and again, once every 2 years, it's to be expected to have a 15 to 20% pullback in the major indices. So if you're at 100,000 and you have that 15-20% pullback, may not be a big deal to you, but if it's your $1 million and you see it, you're like, oh crap. But it's the same process. The same process that got you from 10 grand to 100 grand is going to get you from $1 million to 10 million over a long period of time. And just to kind of go a little bit further and look at the rate, for instance, to go at a 15% compounded annual growth rate. So a growth investor, to go from 25,000 to 300 is going to take you almost 18 years. But to go from 300,000 to $1 million only takes you 8.
Yeah.
So that's why, a lot of times as you're going through your life cycle and your investment cycle, and you're going through getting, peak earning years to going into retirement, that's where you really need to work with someone, because you can't just automatically become more conservative, because once you get to your 300 grand, 8 more years to get you to the $1 million, and you may not, that volatility may be uncomfortable, but if you can have somebody to help walk you through it and keep you invested, you're gonna transition from just going from your highest earning years to going to your highest net worth years.
Right.
And it's important, and you're right, it is difficult. We have to be sensitive to that, because price movements affect. I mean, it's the wealth effect. I mean, that's one of the reasons that the Fed was willing to sacrifice the market in 2022 was, if we can destroy the wealth effect essentially via higher rates and lower market, then we'll tame inflation. And so the opposite's true. When the market's up, you feel good. The market's down, you don't. So yeah, you have to be sensitive to that. But it's as the years go on, it's we're there to kind of be, more. I don't know the words to use.
Well, I think the 30,000 foot view, the takeaway here is long-term views win out.
100%.
And so we're not, even the things that we're seeing in the market now are not signifying to us that we are in a long-term downward trend. That's what's so hard about it, is that the indicators are not pointing either way, but it's all sort of in the shorter term.
Yeah, short to midterm, 100%. Yeah.
So we're looking at this. There will be obviously brighter days ahead. I think in a year from now, the market will be up above what it is now, probably significantly. So it's all semantic, really. I mean, what are we looking at? What are the indicators we're looking at? We're trying to protect, be defensive as we can to protect the downside risk, but also realizing and understanding that we want to take advantage of the upside potential for gain there. And so it's just a hard thing to balance. But yeah, you lean on somebody that you want to work with. Find somebody that you like, that's able to talk to you, that's open with communication, that tells you exactly what's going on and what they're thinking at all times.
And not just what you want to hear. And that's the words that we're kind of escaping, is that, the longer that you do this and the more experience you have under your belt, you're able to really come in and tell people what they need to hear, not what they want to hear. And when you're dealing with your finances and growing your wealth, you want to be told what you need to hear. Not something that just kind of, a lot of brokers, a a lot of commissioned agents that are out there, they're just trying to make a sale, and so they will tell you they'll massage you when the market's down. They'll put you in a fixed annuity, or they'll talk bad about the growth funds that you're in, because it's just all purely transactional. They're just trying to check the box to get that account, get that commission, and it may feel good in the moment if you're being told something that you want to hear that kind of massages the emotional biases that you're currently carrying for whatever reason, whatever that's going on in your life. But you really need somebody on your team that's going to tell you what you need to hear.
Yeah, I was just trying to find this. Actually, it's a very interesting conversation. So last week, we had the regulatory body finally come out and say that brokers are not allowed to call themselves financial advisors. Huge development in the in the advisory space, because there is a definite definitional difference between a financial advisor who is, a fiduciary is the word we use a lot, and who is more in the suitability kind of space, where they can sell you products that are suitable for you, versus an investment advisor who offers advice for investment. So before last week, it was sort of interchangeable. We knew brokers
didn't know that.
that would use the financial advisor phrasing. They can't do that anymore. Cannot call yourself a financial advisor if you are not. I don't know what license you have to do that. I guess it's 65. Is that right?
For broker?
For the definitional. I'm trying to find that on
Well,
there.
it's not just it's 65. You cannot hold a commission license. And that's kind of blurry. The problem is that, all of these warehouses, these broker dealers, they're essentially profit generating machines. And so what you'll have happen is a mix of, let's say you have a big box advisor, not to name any names, but just think of a large financial institution, Wells Fargo. And, let's say you'll have, they will hold multiple licenses, but when they use those licenses in a recommendation, advice, or a sale, they're not the ones making that decision. Who's making that decision is the bank, the broker-dealer they're working for. They're driving, okay, we need this amount of revenue in this bucket, ergo you use this license for that. So even then, it's not truly fiduciary advice. It's not to say that there aren't wonderful and great advisors that are out there that do that, because there are. But it's when you get down to the letter of the law and the way that advice is given, you can't purely just say you're a fiduciary if you're holding the broker's license. That's why, we had all of the licenses, the 63, the 6, the 7, et cetera, over the years, and we dropped everything except the 65, because we purely wanted to be fiduciaries. Because we believe that's in the best interest of the client, and it's also in the best interest of our firm long term. Because every decision we make is for 10 years and 15 years out. And that way our clients don't have to worry about, which is commonplace with brokers, is they'll get a broker at Edward Jones or Wells Fargo or Chase, and inevitably there's a different compensation package that's offered. They jump ship, they go somewhere else. Everybody's constantly changing accounts and trying to move you from one place to the other. And none of that is in your best interest. It's just purely what this advisor needs for compensation.
It's product versus relationship.
Yeah.
And so here's the the federal and state level, actually, brokers are barred from calling themselves financial advisors when they're only legally registered to sell brokerage products and not to give advice. So, Michael Kitts, he was at the forefront of this, writing letters constantly to the SEC to try to get that taken care of. So he's the one that posted that. I saw that last week. But that was interesting, in the scope of the conversation about trying to find somebody to work with. You always want to find someone that's going to be on your side of the table and that can give you that advice that you need, rather than just has, a product for your need in the moment.
Yeah, and because and to be honest with you, compensation for people that manage money like we do, our compensation is tied to the long-term outlook, and it is tied to a long-term relationship. It can take us anywhere between 4 to 7 years to make the revenue that a broker can make in 1 month off a new relationship,
depending on the product.
Depending on how that is, what product that broker is selling. And we're perfectly fine with that, because our clients know that we are incentivized to be there for them, to perform for them, to give quality advice inside and outside of the accounts for years and years and years to come. And that's really what you do want to look for, whether it's us or whether it's somebody else. That's what you want to look for, is is relationship over product. That's a great way to put it, and I was not aware of that distinction. So hopefully that also means that insurance agents that have been going out there calling themselves investment advisors,
financial advisor,
financial advisors aren't able to continue to do that as well.
Yeah, it should be good for the industry as a whole.
Yeah.
Anyway, we got some things coming up this week, economic events. Mainly what we're going to be looking for is there are a lot of Fed speeches this week, a lot. So we will be interested to see what they say, what kind of language that they use based on.
I predict dovish. I'm going to go ahead and put it out there.
Yeah, what kind of language they use in regards to lowering interest rates. They have thus far been sort of, I think there's only one that has said he's sort of in favor of lowering. So we'll see if more of them flipped over after last week and all the tariff stuff. Be very interesting. But yeah, anyway, that's all we have for today. I would just say it's mixed still. We're mixed. We're still waiting. We're still watching. I don't think the downside volatility is over. I wish it were. I hope it is. But we're going to be constantly watching and constantly looking at the technicals and the underlying fundamentals of the market.
And it's going to be very interesting when we're at the reset point in the market. It may already be there. We don't know. But it's going to be very interesting to see where the data is leading us for sectors that could potentially outperform. Because we do every time we have this reset, we see that.
Yeah,
we
that's
see
true.
The sectors
COVID, you had the rotation into healthcare.
Oh yeah, it's incredible how it picked up on what was going on. So I would just simply say, just to reiterate on my parting thought is, consume the headlines sober-mindedly. Reach out if you have questions or concerns. Consultations with us are free and no obligation. MomentumWealth.us, and get somebody that is focusing on the long term, because you definitely don't want to be on the sidelines when all of this uncertainty becomes certainty. You don't want to be
sitting
on the sidelines. We've seen that so many years. You don't want to do that. And yeah, we'll be bringing you more information. I guess really wasn't too much exciting information and data this week.
Everyone's on the edge of their seats, wondering where we're going to go.
Where are we going? This is the question.
I don't know.
Yeah.
Somewhere fun, hopefully.
Yeah, I think so.
All right. Well, be sure to check us out next week. We'll talk more about stuff like this. Like and subscribe.
I had so much sun this weekend that I feel drained. The coffee's not getting it. It's just I got way too much sun exposure.
I didn't get any coffee today. I don't have a mug here.
Yeah.
Anyway, check us out next week for another episode. Like it, subscribe it, share it with a friend if you feel it's helpful. If you have questions or want somebody to talk to, reach out to us, and we will see you next week.
Yeah, and maybe next week I'll do an ASMR version of the fine print.
Oh my God. Something to look forward to.
Yeah, take care.
All right,
Peace.
goodbye.